Depreciation schedule for commercial real estate. So if you own or plan to buy commercial real estate, understanding depreciation can put serious money back in your pocket. So let's talk about the depreciation schedule for commercial properties and how it actually works. So what is depreciation? Well, depreciation is a tax deduction that lets you write off the value of a building over time. Even if your building is appreciating in value, the IRS lets you take a loss on paper every single year. That's the power of real estate tax benefits. So what's the schedule of depreciation for commercial real estate? Well, under IRS rules, commercial real estate is depreciated using the MACRS system. What that stands for is that's the Modified Accelerated Cost Recovery System. And it uses a straight line method of a period of 39 years. So what does that mean? You take the cost of the building, exclude the land. You can't depreciate land. And you divide it by 39. That amount becomes your annual depreciation deduction. So example, if your building costs $1.17 million, you divide it by 39 or 39 years, that's $30,000 a year in deductions. Now important, remember, land doesn't depreciate. Only the building and capital improvements are depreciated. The land value must be subtracted from the total purchase price. Usually, your CPA will use the county assessor's breakdown or an appraisal to allocate that land value. So do you want to accelerate the depreciation? Well, you can speed up depreciation using a cost segregation study. This breaks the property components into different categories: carpets, roofs, paving, fixtures, parking lots. Some of these can be depreciated over 5 years, 7 years, 15, or 39 years. And then add in bonus depreciation, and you can front load a big tax write-off in year one. So why does this matter? Well, depreciation offsets your rental income. It can also offset capital gains from other passive income streams. If you use it properly, it helps you keep more of your cash flow while deferring taxes until the sale. An example would be you sold a property for $2 million. You had a $1 million gain. You want to offset that capital gain, well, by buying another asset and getting depreciation. That excess depreciation that year that you bought the asset, especially if you did a cost segregation study and had bonus depreciation, that will flow through to your personal tax return, and that will help offset that $1 million capital gain that you incurred that calendar year from selling a real estate asset. This is a powerful strategy to help you compound your wealth without paying tax each year and diluting your capital balance that you're working to compound and grow. So the final thoughts is the 39-year straight line schedule is your baseline. But with the cost segregation study, bonus depreciation, and a smart tax CPA and strategy, you can unlock much more. With cost segregation study, bonus depreciation, and a smart CPA with a strategy, you can unlock a lot more wealth. Depreciation is the silent wealth building if you use it wisely. So if you want to run your own depreciation numbers and explore cost segregation strategies, download my free tool, the Commercial Real Estate Depreciation Calculator. This will help you model out the depreciation schedule if you choose to use the straight line method versus the accelerated depreciation method. That way you can plan and make smarter tax moves. Also, check out my next video on bonus depreciation and how it's changed with the latest tax legislation, the big beautiful bill. You won't want to miss the details on how to front load your deductions. So I'll see you on that video so you can make better real estate investments.